open up your report there to page 1, kind of the middle left-hand corner, you'll see the year-to-date number. And again, keep in mind these numbers are through the end of the first quarter. We're up 2.21% as a net number. Put that in perspective, the Dow Jones was up 2.2%. The S&P 500 index was up 1.35%, and in a mix of 60-40 allocation was up 1.57. So from a relative standpoint, we're doing okay. Yep. Regarding during the quarter, we had withdrawals of just shy of 1.4 million. Is what I had at Bob. Is that? Yeah, that's right. And at the end of the quarter, we stood, our asset allocation stood at 57% in equities, 7.5% in REITs, the Real Estate Investment Trust Manager. Fixed income was at 32%, and cash was around 3.5%. And all those fit within our investment policy at this point, pretty much right on target. Any questions there? On that second last page, on the top half of it, we just kind of list our managers that we're using in the pension plan, and focusing mostly on the quarter numbers here for the year. CS McKee Large Cap Value was actually down 0.63% for the month, or for the quarter rather. Wedgwood Partners, which is a large cap growth manager, was up 1.18% for the quarter. John Hancock, Sovereign, sometimes we refer to that one as Sovereign, was up 3%. It's a little more of a large cap value manager. Aston is a small and mid cap manager. They were up 3.83%. The London Company was up 4.11%. Royce was up 5.28%. Uniplan is your real estate investment trust manager. They were up 6.23%. Victory is an all-cap manager. They were up 4.49% for the quarter. CS McKee Fixed Income was up 3.2%. And Confluence, which is our newest manager, we added them in the fall, was up 0.74% for the quarter. So all in all, I think the managers are doing what they're supposed to be doing relative to what the market's providing at this time. Brett's going to talk a little bit more to the markets. You know, we look at some other numbers. We like to look more. We look more at risk management as opposed to just total return and performance. And all the managers are still in line with what we would expect as far as the amount of risk they're taking on versus return. And then during the quarter, the other thing I wanted to point out, well, actually two more things pertaining to this. Any withdrawals, we've been kind of taking a little bit more out of the equity side of things as opposed to the fixed income. Our equity position has still been within our range with the investment policy, but based on where the markets are right now, some things we're looking at, we just thought it might be better to pare back the equities a little bit. Nothing dramatic, but just so you're aware of what's going on there. And then the other thing I wanted to point out, particular to a money manager, we've talked a lot about Sovereign, and they've kind of had some lagging performance. This particular quarter, the first quarter, you can see there is some outperformance there compared to their benchmark. So we continue to watch them. We're anxious to see how they'll do here in the second quarter. If that will continue, that makes us feel better. One of the things I think that's going in their favor now is value-oriented stocks are becoming more in favor as opposed to growth-oriented stocks. And Sovereign definitely is value-oriented, so they should be pulling their weight right now. And at least through the first quarter, that appears to be the case. Okay. Any questions? And just at the end of the quarter, just so you have a balance here, the total fund was at $113,557,000.
As Mike mentioned, he just mentioned there at the tail end about Sovereign, more conservative, more value-oriented managers, with some anticipation that hopefully we see a little bit of performance out of them. The fact that we've been taking the money for the withdrawals, more so from the equity side, just trying to pare things back a little bit. Part of the reason for that is the fourth quarter, I'm just going to read a couple updates here too. The fourth quarter, our GDP was about 1.4%. Estimates for the first quarter, numbers not completely and finally in it, but it looks like it's going to be around 1%. So we see a trend of the economy slowing a little bit. Just to give some perspective, if you look over the last 40 or 50 years, the GDP growth has been more around 2.8% is where it is. But expectations, not to keep throwing numbers out, expectations this year that were given, and I think we'd shared actually maybe in the last meeting or so, was probably about 2.25% this year. So we are trending down a little bit right now. It does appear that we're going to be a little bit slower than what was originally anticipated. Kind of that's a little bit of a negative. On a positive side, just to give a little bit of perspective too, household debt service, more or less how much disposable income in a typical household across the United States is being used to service debt. Back in 2007, kind of at the peak of our leveraged market when people were borrowing excessively, was about 13.2% of disposable income was being used, where today it's closer to about 10.1. So Americans have certainly paid down debt, which is a positive thing for the economy. In the last quarter, the last 3 months or so here, the deterioration in China has become a little bit less of a concern. They've had a slowdown over 2015. We were talking about some commodity prices, specifically oil. I think most people probably know that. You go to the gas pump and prices are cheap. Gas prices had come down. Oil has, and some other commodity prices have appeared to stabilize some, which is a positive thing as well. That's actually a good thing. And China, again, I mentioned about things seem to be settling down there a little bit. Most of the growth that we're seeing on the equity side of portfolios a lot of times has been more so from dividend than it has been really from appreciation at this point. On the fixed income side, on the bond side, specifically the portfolio, I'm going to just read a little piece here. It says the globe remains starved for yield. I just want to get the specifics of this. That's why I want to read it. $7.8 trillion of debt issued by developed world governments now yields below 0%. This is about 25% of the outstanding developed world sovereign debt. By contrast, only about $3 trillion yields more than 2%, much of the amount consisting of our own U.S. Treasury debt. So we talked about interest rates being low, and Mike was saying about trying to focus with companies, with our managers like Sovereign and so on. They're focused on higher quality, and I think probably more so than we remember in a long time. They're very, very focused on high quality companies, because at some point in time when rates start to bump up some, and we have seen a little bit of that already, companies that are leveraged are not going to be performing as well. So we're looking for companies that do not have as much debt on their balance sheet. I guess kind of two quick takeaways as a general whole. One is I just mentioned about the fact that the overall portfolio, several of our managers, Sovereign, CS McKee Equity would be another one, and Washington Crossing would be another one that's focused on higher quality companies. So we're focused on that for one. And then the second thing is it appears from yesterday's notes, this is a little bit more recent news, that the Fed is very much wanting to see another bump in interest rates in June of next month. So we'll have to wait and see if the economy, if they feel like the economy can sustain that or not. So, any questions with any of that at all?
No, I open it up to